Every day, you make decisions that ripple across your team and business. You weigh options, manage resources, and guide your people toward a common goal, translating ideas into action. Yet, in a world driven by data, there's a frustrating gap between the actions you take and your ability to see their financial impact. This video is all about closing that gap and how to move from simply managing your function to steering your business with clarity and confidence. You'll learn the framework to translate that financial noise into a clear, compelling story. This has nothing to do with becoming an accountant, though. Instead, you'll gain the strategic literacy to make forward-looking decisions that create tangible value. By the end, you'll have a new way of thinking, able to participate in any high-level discussion and justify your ideas with the persuasive language of finance. If that sounds good, let's get started. To manage any part of a business effectively, you need clear information to guide your decisions. Without them, you're driving blind and relying on instinct alone. It's what sets the most successful leaders apart. They learn to read the instruments available to them, transforming complex data into a clear story about where the business is and where it's heading. Think of it like reading a car dashboard. You wouldn't start a long journey without knowing how to check your speed, fuel, or engine temperature. In business, financial statements provide that same dashboard. Learning to read them is the first step toward true financial literacy. Your first and perhaps most watched gauge is the income statement. This is your speedometer. It tells you how fast your business is generating profit over a specific period, like a quarter or a year. It answers the fundamental question, are we making money? Starting with all revenues from sales, it subtracts all costs and expenses incurred to generate those sales. The final number, the bottom line, is your net income or profit. But profit and cash are different animals. A company can look highly profitable on its income statement, but still face a cash crunch if customers haven't paid their bills yet. The speedometer might say you're going fast, but how much fuel is in the tank? For that, you need the balance sheet. If the income statement is your speedometer, the balance sheet is your odometer and fuel gauge combined. Rather than measuring performance over time, it captures your company's financial position at a single moment. It's built on a simple equation. What you have must equal where it came from. In financial terms, the formula is assets equals liabilities plus owner's equity. Assets are resources your company controls, cash, inventory, equipment that will provide future economic benefit. Liabilities are what you owe to others, like bank loans or payments to suppliers, and owner's equity is what's left for the owners after all debts are paid. Together, these components show the cumulative result of every decision made since the company began. Now we come to the most critical gauge for short-term survival, the cash flow statement. This is your fuel consumption report. A business runs on cash, and this statement shows exactly where your cash came from and where it went. Arguably the most objective of the three gauges, the cash flow statement deals only with hard currency. It breaks down cash movements into three categories. First, operating activities, cash from your main business. Second, investing activities, cash spent on machinery or property. And third, financing activities, cash received from investors or used to pay back debt. The statement explains how a company reporting large profits can still be running out of cash. Together, these three instruments, your speedometer, odometer, and fuel gauge, provide a complete picture. Relying on just one gives you a distorted view. But when you learn to read them all together, you can make informed decisions with clarity and confidence. So, you have your dashboard in front of you. The gauges are lit, the engine is running, and you're ready to assess your journey. Your eyes go to the speedometer first, the income statement, to check your current performance. You see a number, say $50,000 in profit for the quarter. You feel accomplished. But then a question surfaces. Is that good? If you made $40,000 last quarter, it seems like an improvement. But what if your sales doubled? And how does that $50,000 compare to your main competitor? Suddenly, the raw number feels isolated and meaningless. This is the central challenge of financial analysis. You need context. Without that, numbers just take up space. The key to unlocking the story is a simple technique that allows you to compare any company of any size at any time. The technique is to create what's called a common-sized income statement. You take every line item on your income statement and divide each one by your total sales revenue. In an instant, all your absolute currency figures become simple percentages. Your sales revenue becomes the 100% baseline, and every expense becomes a percentage of that baseline. This removes the distorting effect of size and creates a universal language for performance. Now, your $50,000 profit might be an 8% profit margin. You can meaningfully compare that 8% to the 7% you achieved last year, or to the 6% your massive competitor manages. You are comparing the fundamental efficiency of each business. Once you have this common-sized perspective, you can diagnose the health of your business with precision. The first percentage to analyze is what's called your gross margin. For every pound of revenue, how many pence are left after you've paid for direct costs? Raw materials, direct labor, manufacturing. A high gross margin suggests strong pricing power or efficient production. A low or declining gross margin can be an early warning that input costs are rising or you're competing on price. After grasping product profitability, you zoom out to the efficiency of your entire business. This is where operating margin comes in. This percentage shows what's left after you've paid for the product and all other business costs, marketing, salaries, rent, and research. Your operating margin tells the story of how well you run day-to-day operations. You could have a fantastic product with high gross margin, but if you're spending too much on lavish offices or inefficient marketing, your operating margin will suffer. It's the true measure of management's ability to control costs and generate sales. By turning raw numbers into these two percentages, you move beyond seeing data and begin to grasp performance, allowing you to ask smarter questions and pinpoint exactly where your business is winning or losing. The profit margins we just explored tell you what you're earning on each sale, which is valuable information. But here's where things get interesting. Profitability alone can mislead you. Two companies with wildly different profit margins can have identical success rates. The missing piece of the puzzle lies in how efficiently you use your resources, your inventory, your equipment, your buildings, to generate those profits. This efficiency measurement changes everything about how you evaluate performance. In business, this means you must connect your profitability to the assets and resources you use to generate it. This connection shows your company's true operational efficiency. The metric that captures this is called return on assets, or ROA. It is the great equalizer in business, and it answers a simple question. For every pound you have invested in resources, like inventory, buildings, and equipment, how many pence of profit do you generate each year? This single number cuts through the noise and shows how good you are at using your stuff to make money. To see how two vastly different companies can both be incredibly successful, consider the stark difference between Walmart and Tiffany's. One sells household goods with razor-thin profits, the other sells diamond rings with enormous markups. Yet their operational efficiency, as measured by ROA, has been nearly identical. The reason is that ROA is driven by two fundamental levers, and these companies have chosen to pull opposite ones. The first lever is profit margin. This is the Tiffany's lever. Tiffany's makes an enormous profit on each individual sale. In 2010, their profit margin was over 13%, meaning for every dollar of jewelry sold, Tiffany's kept 13 cents in profit. That expensive necklace might sit in a display case for months before it sells, meaning the assets are working slowly. The second lever is asset turnover. This is the Walmart lever. This metric measures how efficiently you use your assets to generate sales. Walmart's business model relies on making a small profit from each item sold. Its profit margin is a mere 4%. Its genius lies in the sheer volume and speed of its sales. It sells through its entire inventory at a dizzying pace, generating far more sales revenue for every pound invested. So while Tiffany's assets turns over less than once per year, Walmart turns over almost 2.5 times that speed. So Tiffany's wins on the margin, Walmart wins on turnover. When you multiply these two levers together, profit margin times asset turnover, you get the total ROA, which shows that their overall efficiency is remarkably similar. This insight shows that you have a strategic choice. You can build a business based on high margins or one based on high turnover. Knowing which lever is the primary driver for your business is the key to making decisions that boost your true, holistic efficiency, rather than just focusing on one piece of the puzzle. So, you've grasped how ROA balances margin against turnover. That's strategic thinking. Now comes the practical challenge. Every day you face dozens of decisions about pricing, orders, and production. Should you accept that below-cost order? The problem is that most managers use a flawed tool that leads them into expensive mistakes. The most common trap is the idea of an average cost per unit. It seems simple enough. You take your total costs for the month and divide them by the number of units you produced. This gives you a single number that supposedly represents what each item costs to make. Think about it like this. A potential new client offers you a large, one-time order at a price below your calculated average cost. Your gut reaction is to reject the offer. After all, why would you ever sell something for less than it costs to produce? The problem is that average cost number is a dangerous illusion. It's hiding a fundamental truth about your business. This is because your costs fall into two completely different categories. First, you have fixed costs. These are costs you pay no matter what, whether you produce 1 unit or 10,000. This includes factory rent, supervisor salaries, and machinery depreciation. They're the background costs of being in business. Then you have variable costs. These are costs you only incur when you actually produce one more item: raw materials, direct labor, and the electricity needed to run machines for that specific unit. Your average cost dangerously lumps these two very different types together, giving you a misleading number. Once you separate these costs, you can use a far more effective tool: the contribution margin. It's a simple calculation with major implications. For every product you sell, the contribution margin is the sales price minus only the variable costs needed to produce it. This number represents the actual cash each sale contributes toward paying off your fixed costs for the month. Once all your fixed costs are covered by the combined contribution margins from all your sales, every additional pound of contribution margin is pure profit. Now let's return to that special order. The client offered a price below your flawed average cost, but what if that price is still higher than your variable cost? In that case, the sale generates a positive contribution margin. That's extra cash that helps pay for the factory rent and supervisor salaries you were going to pay anyway. By accepting the order, you are better off than before, and your total bottom line profit for the month will be higher. This shift in thinking, from a misleading average cost to the precise and actionable insight of contribution margin, is one of the most valuable tools you can possess for making consistently profitable operational decisions. So you've built your toolkit piece by piece, reading statements, analyzing margins, separating costs. These skills help you manage what's happening right now. Yet every business faces moments that require looking ahead. Should you build that new facility? The challenge is comparing concrete costs today against uncertain future benefits. Making a strategic bet, like investing millions in a new factory that will pay off years later, is one of the most difficult decisions you'll face. How can you possibly compare a definite cost today with a potential benefit 5 years down the road? The answer lies in a single financial principle: the time value of money. It's an idea you already grasp intuitively. If someone offered you $1,000 today, or the same $1,000 a year from now, you'd take the money today. You know that today's money holds more value. You can invest it, earn interest, and have more than $1,000 in a year's time. This simple preference is the bedrock of all modern finance. A pound received in the future is always worth less than a pound in your hand today. To make sound long-term decisions, you need a way to translate all future cash flows back into today's value. This is where net present value, or NPV, comes into play. Think of it as a tool that calculates a project's true financial worth in today's money. It works from a simple principle. Cash you'll receive in the future is worth less than cash you have now, because today's money can be invested to earn a return. NPV calculates this difference by discounting all expected future cash inflows, essentially shrinking them to their smaller, present-day equivalent. The riskier a project is, or the longer you have to wait for a payoff, the heavier the discount. After translating all future gains into today's value, the calculation subtracts the initial investment cost. The result is a single powerful number that strips away gut feelings and emotion. This number represents the total net value the project adds or subtracts from your business today. The decision rule is straightforward. If the NPV is positive, the project is a green light because it's projected to earn more than your minimum required return and create real economic value. If the NPV is negative, it's a red light. The investment would make the company poorer and should be rejected, no matter how promising it seems. This is the final piece of your financial toolkit. From learning to read your dashboard, to analyzing performance and getting control of costs, it all culminates here in your ability to look into the future and make sound, value-creating decisions. This framework completes your transition from a manager who oversees the present to a leader who confidently builds the future.